This podcast is for informational purposes only and does not constitute financial advice. Consult with a qualified professional before making any investment decisions.
Welcome to the Wire Weekly Roundup. The week in real estate presented in digestible bites. Hold on while our AI hosts take us on another ride through this week's top real estate headlines.
Welcome back to the deep dive, everyone listening on The Wire. You send in a ton of recent real estate news and analysis, and today we're digging in. We're trying to cut through all that noise and get to the heart of this question. Home prices under pressure. Is the housing crash finally here?
Exactly. And for all you pros and enthusiasts out there, we're not just reading headlines. We're pulling together different viewpoints, looking at trends, spotting the contradictions in these reports. The goal is to figure out what this really means for your business, for your investments. So let's get into it.
Okay, let's start with the big one, probably the most immediate driver.
Yeah.
Mortgage rates. We've been watching them like hawks for weeks. What's the absolute latest? And maybe more importantly, what kind of immediate impact are we actually seeing?
Well, the really big story this past week is the drop, a significant one. Mortgage rates actually hit a 10-month low around August 14th. We saw that in real estate news, the mortgage reports, Realty Times, and they've kept sort of ticking down daily since then. So it's not just a blip, it feels like a real downward move.
Right. And are people actually, jumping on this? Are borrowers reacting in a way we can measure?
Oh, absolutely. The reaction was fast and pretty dramatic, actually. Weekly mortgage refi applications, they shot up 23% in just 1 week. That brought them to the highest level since, April? CNBC reported that on the 13th.
Yeah.
It really tells you that borrowers were basically sitting there waiting for a chance like this. There's clearly a lot of sensitivity to rates.
Okay, 23%. That's substantial.
Yeah.
So rates fall, refis jump. Does that just automatically mean things are looking up for the whole market? Are property values getting a boost? Are deals suddenly easier to make for buyers and sellers?
Well, it's definitely a positive sign, yeah. Falling rates can help support higher valuations. I mean, lower borrowing costs make homes technically more affordable month to month, right? Which could prop up prices. There was a CNBC piece on the 14th suggesting it might improve the deal environment. But, if we zoom out, it's not quite the silver bullet everyone might hope for.
Yeah, that's the tension, isn't it? Because even with these lower rates, all we hear about is affordability. Or lack thereof. It feels contradictory. How can rates be down, but homes still feel so out of reach? What's the bigger picture?
You nailed it. That's the core paradox right now. Rates are easing, but experts, they're still ringing the alarm on affordability, maybe even louder. Ivy Zellman was on CNBC. This was the 15th, saying affordability is the most stretched it's been since the early 80s. Think about that. And NER's Lawrence Yun, also on CNBC a few days earlier, he stressed that even these lower rates are still a major barrier. It's not just the monthly payment calculation. It's this whole storm of high prices compared to wages, plus rising taxes, insurance, you name it. So even if the rate looks better, just getting in the door, that upfront cost, it's still a massive hurdle for so many people. Keeps buyers sidelined. And it's not just about buyers struggling. We've also got real issues on the supply side holding things back. Getting credit is getting tougher for builders. Ion Housing reported that around August 8th. So financing new projects, harder. Plus, the cost of materials actually went up in July. Ion Housing again on the 14th. So, okay, lower rates might juice demand a bit, but if you can't build enough new homes affordably, those supply constraints, they're sticking around. And that keeps pressure on prices for what's already built.
Right, so we have this affordability squeeze from both sides, buyers struggling even with lower rates, and builders facing headwinds, which loops us right back to that main question, the one in the headlines. Are prices about to tumble? Is this it? Is the crash here?
Looking across all the sources we reviewed, the consensus is pretty clear. And consistent. It's basically, don't count on a crash. That was a direct quote from Real Estate News on the 13th. And it's not just a simple no. It reflects a bunch of factors suggesting the market's showing resilience. It's adapting, not collapsing. Unlike past downturns driven by bad lending or just way too much inventory, this market seems to be, adjusting more strategically.
Adaptive resilience. I like that. So it's shifting, not breaking. What signs point to that kind of resilience? What's actually happening on the ground?
Well, one key thing is new construction patterns. Yes, single-family permits dipped in June, but guess what? Multifamily construction actually gained. Ion Housing reported that on August 8th. So developers aren't just stopping, they're shifting focus. They see the demand for potentially more affordable, denser housing. It's a rebalancing act, not a full stop. The market's trying to find ways to meet demand differently. And then there's a broader economy, right? That provides some underlying support. The U.S. economy did rebound in the second quarter. Ion Housing mentioned that on the 13th. That's really important. It means people generally have jobs, income. There's fundamental strength there, even if things slow down. It acts like a buffer against a total collapse.
Okay, that makes sense. Pressure, yes, but also adaptation and some economic support. But adaptation also means things aren't uniform, right? Which brings up that really interesting Zillow finding. Mansions under $1 million still being normal in 4 specific markets. What does that tell us? That things are really, really local, and maybe where the opportunities still are for our listeners.
Yeah, that Zillow detail from the 13th. It's a perfect example of why you can't just read national headlines. The overall market might feel pressured, sure, but specific regions can be singing a totally different tune. Unique opportunities pop up. So for agents advising clients or investors looking for deals, you absolutely have to dig into that local data deeply. I mean, Bigger Pockets is even calling the Southeast potentially the last great real estate gold rush in the U.S. Because of jobs, migration, it just highlights that even in a tough overall climate, there are still pockets of serious opportunity if you know where to look.
And thinking about other pressures beyond just price and rates. We saw this piece saying credit history is now hitting home insurance costs harder than climate issues in some cases. That seems like a potentially big hidden cost for buyers.
It's a fascinating shift, isn't it? Real Estate News reported that on the 16th, for buyers, it means even if you lock in a decent mortgage rate, a shaky credit history could seriously inflate your insurance bill. That's another barrier, or at least a big hit, to the monthly budget they might not expect. Insurers are basically changing how they calculate risk. They're seeing financial responsibility, your credit score, as a maybe stronger predictor of claims than even where the house is, geographically speaking, at least sometimes. So for you pros listening, you need to be talking to clients not just about mortgages, but how their credit impacts all the costs of ownership. It's a crucial detail.
Okay, this is where it gets really interesting for everyone in the wire community, the people actually in the business. How are all these big shifts changing the industry itself? We're seeing some fundamental transformations, right, affecting agents, brokers.
Yeah, and maybe the most surprising thing we found is this. It's been a year since NAR's new commission rules kicked in. And guess what? Commissions are actually up. Real Estate News reported that on the 16th. Now, that goes against what a lot of people expected, right? They thought agent pay would take a hit. But it implies that good agents, the top performers, are really proving their value. They're adapting, maybe negotiating differently. It shows that skill and expertise in navigating this complexity. Still highly valued. Profitability isn't just tied to the old ways. It's about being agile, showing your worth.
Huh. Commissions up. That is surprising. And at the same time, we're seeing huge moves in the tech space. Opendoor CEO stepping down, activists claiming victory. What's that telling us about iBuying and that whole tech-driven model?
That Opendoor news, yeah, CNBC and Real Estate News covered it on the 15th. It definitely signals more scrutiny, more pressure on the iBuying business model. When activists claim victory like that, it's not just about who's CEO. It's a loud demand for actual profits, a sustainable model. It challenges that old grow fast, figure out profits later tech mindset. Seems like a tech real estate space is maturing. Efficiency, financial results, they matter now. But while some tech players seem to be facing headwinds, look at the traditional brokerages. They're making big moves. Howard Hanna ERA just nabbed over 90 agents. Real Estate News called it a growth move on the 16th. And United Real Estate, they announced this bold goal, double our size in 3 years. That was Real Estate News on the 14th. So you see this clear strategy. Expand, consolidate, use their existing networks and resources to grow.
Right, so the big traditional players are definitely consolidating power, expanding their footprint. And you mentioned Gary Keller rallying KW agents, saying empires are being built. Real Estate News covered that on the 12th. Sounds like a real call to action, doesn't it? Reinforcing that idea of strategic growth, maybe needing to be part of something bigger.
Exactly. It's a strong signal. Even in a market feeling pressure, the smart money is on strategic growth, scale, efficiency, leveraging those networks.
Now, shifting gears slightly to investment, this could be huge. There's a new executive order possibly allowing real estate into 401ks. What could that mean for real estate as an investment, especially for, the average person listening?
Oh, that executive order. Yeah, Bigger Pockets detailed it on the 14th. It really does have game changer potential, seriously.
Yeah.
Letting real estate be bracketed into 401ks, that massively opens up access. Before, direct real estate and retirement accounts was tricky for most people. This could unlock a huge amount of new capital for the market and for everyday investors. A powerful new way to diversify, build wealth through real estate within their retirement savings. It could make it much more mainstream. And it kind of fits with this other trend we're seeing. More political focus on housing. Real Estate News noted on the 14th that federal lawmakers seem to be finally taking housing concerns seriously. And President Trump's proposed Big Beautiful Bill, which CNBC mentioned on the 15th, is seen as having potential benefits too. It just signals more government attention, which could lead to new policies, maybe funding, things that support the market somehow. And just one last thing, looking way ahead, even cutting-edge tech is starting to intersect here. CNBC reported, this was on the 12th, that quantum computing is being seen as a potential tailwind for commercial real estate. I mean, think about processing massive data sets instantly, revolutionizing property modeling, location analysis, even building operations. It's way out there, but something to keep an eye on.
Wow, okay. We definitely covered a lot of ground there for you, our Wire listeners. Let's try to boil it down. Key takeaways. Mortgage rates are down, helping refis, but affordability is still really tough for many. That's clear. The market's pressured, yeah, but the consensus, no crash. It's adapting, shifting, showing resilience, especially regionally. Opportunities are definitely still out there. And the industry itself, big changes. Consolidations, strategic moves, plus new policy ideas like the 401k thing, and even wildcards like quantum computing down the line.
Absolutely. And don't forget that surprising insight. NAR rules are in, but commissions are actually up. It shows skilled agents are finding ways to demonstrate value. So the big takeaway for all you professionals listening, it's not enough just to know the headlines. You need to see the trends underneath, the contradictions, the shifts. Being agile, informed, proactive. That's how you spot and grab the opportunities that are definitely still there in this very dynamic market.
That's a great closing thought, which leaves us with one final question for you, our Wire listeners, to chew on. With all these shifts, tech, policy, market dynamics, what does being a top-performing experienced agent or broker even mean in the next few years? What new skills, what niche expertise will be absolutely essential for success? How are you getting ready for that future? Something to think about. We'll catch you on the next deep dive. If you're interested in your own personalized edition of The Wire, please visit us at thewire.fm/custom. We offer market-specific podcasts with all the latest real estate news and market analysis delivered to you weekly or monthly. Own your market with a personalized edition of The Wire, the week in real estate. Thank you for listening.